Greetings, market rebels. Welcome to this week's macro measure. Wayne here. It is actually Friday, June 7th, but we're keeping our naming conventions for now. And it's about 4:30-ish on the East Coast. So the market's closed for the week. We'll get right into it. As I've been noting a lot of late, I've got many things going on virtually every weekend and traveling different things for different reasons. And so I'm going to try to take care of these videos on Fridays. And if there's ever some major over the weekend development, try to get back and maybe put a little update together. But anyway, here's our trusty disclaimer. And here is our trusty intellectual property rights notice. And then here is this week's slide. Again, a lot of things are left off the table, but I'll cover these as quick as I can. First of all, go to 2x on your playback speed. I'm calling this week a mixed bag mess. You got new highs in the spies and Qs, but I do think the week once again ended on a whimper. I would save time now, and if you want a really table pounding prediction, just skip the entire video because I really don't do that very often in front of FOMC meetings like we've got next week. So I think we just have to wait and see. I think there's a lot of mess out there, which we'll talk about, that could be resolved one way or the other, post FOMC. We'll see. Anyway, I think we're still waiting for more clarity, right? We've been thinking about what typical or most common scenarios could play out, and we have been waiting for that, and we just don't know yet, right? We did get to new highs. We did come in, I think, to the week thinking, as I noted with last week's comments there, it seemed to be true that there was enough short-term oversoldness that it could be, right, laying the groundwork for a bounce. And we were even seeing the bounce unfold as I was recording late last Friday. So the question now becomes, right, where did this carry to? Well, for the spies and Qs, it carried to new all-time highs. They were actually made today, but kind of afterwards, there wasn't much follow-through on that. And we dropped back down to the range we'd been in really since late Wednesday. So that's why I'm saying we ended with a whimper. I think we did get that relatively news neutral weekend. They came in and rallied. We weren't surprised by a bounce. I don't think we should have been. So I think that was all good. Now we just have to see, after the rallying they did, why did this end on a whimper? Is it really just profit taking, right? Which it probably is a little bit of that. Is it folks just deciding to square up in front of the FOMC, where they'd rather just kind of neutralize a lot and then see what comes of it? Tough to say, right? It's very hard to predict what's going to happen. I don't really expect anything to happen at this meeting, but there could be language, according to Ryan, there could be language that he's read where things sort of change a little bit, that indicates that maybe something's coming sooner than later. That did seem to happen in the EU. So I guess there's a little bit of a precedent for that. But anyway, I looked through the market, the breadth just wasn't all that great. Sectors were messy as well. SMH, which has been the leader, right, and really the focal sector, and it often is, especially with what's been happening with Nvidia, that did pop, did make a new high, but then it really sputtered since, right? You kind of had that gap up opening on Thursday. They sold into that pretty heavily. They did actually have an inside day today, which is indecisiveness. But anyway, that just didn't really finish strongly. Maybe there'll be one out of the gates before the Fed, and that'll really goose things. So there'll be even more pressure on the Fed not to flub it up, as they say. But anyway, we've noted this before. We're coming into the summertime months. We're already into June by a week now. And the cycle says that presidential election cycle, that is, we do usually get good performance now. So it started out pretty well. The buybacks are set to dry up, though, so in about a week or so. So just keep that in mind, because that's been a big supportive factor in the market. The early in the month capital coming in, we talked about as well, and that did seem to get things off to a good start. So that's where we are. And a lot of this is similar to last week, where the wheels are still coming off, right? It's been revealed that all the job creation since the COVID madness has actually been for non-native folks in the country, right? So basically all legal and illegal immigrants as they're classified, they account for all the job growth. So it's really no wonder, right, why so many people are feeling the stress financially, right, in terms of their job. There's not been an addition of jobs as far as they're concerned, and they might even be losing jobs as a matter of fact, but that's a whole nother matter. Depends on how much you want to call into question certain statistics, which are dubious, I think, at best. But anyway, the situation just across the board economically isn't good. And then you add to it inflation, which, as we all know, in the real world is understated. We also have the banking stability thing that we've been harping on, not pounding the table that we got to get short, but just saying it's still there. Can't lose sight of that. That's sort of came back a little bit. And the geopol certainly, with what happened with the NATO Russia madness that's currently unfolding, that's there as well. That ratcheted up even more. So I think that there's still concern out there in my mind for this market. I think it's becoming more and more difficult to love this market. We did love the market in terms of being objective, we think, right, in terms of the charts, probably a little while ago, maybe like a month plus, 2 months ago. Things looked really great here or there, but you rarely get that for that long, right? That where everything looks so wonderful. And of course, it didn't change that far after we were looking at it that way, kind of like, it doesn't really get much better than this. And then certainly did not for very long. Anyway, I do think that the leaders have poor profiles, at least for now. I think with the SMH fizzling, XLK hesitating, XLC acting like SMH, which started out like gangbusters, but kind of had a rough finish to the week. And I'm still seeing what I would say is a lot of hedging happening in terms of call buying and things, then stocks then just moving the other way. So I feel like that's dual-sided, where you could see some players are right here and there with that type of trading, right? Just synthetic puts essentially. But some of them are often early, so we can't really know for sure who's doing what, but that often shows up a little too early, and so that could actually aid another rally attempt at the very least. The diamonds rallied into the underside of SMA resistance, which will show. IWM, one of our main canaries, had a rough week again. So did the XTN, and the Nothing Cuervo is just a memory of mine from college days when I had a friend, and that's anything he could ever squeeze in with about Cuervo, he would say Nothing Cuervo, meaning nothing special about this, that, or the other thing. But yeah, nothing special really with XTN. It didn't fall apart, but it really didn't make progress back to the upside after trying to bounce last week. So nothing special happened there. There was really no follow through. Still has lower high, lower low in it, so not good there yet. Could be something that it can build on. We'll see. But the dollar and TNX fell below the key support earlier in the week, but then they really screamed on Friday back towards those key support lines that we were looking at. So I'll try to show this, but I usually cover them. So we'll make sure we try to get to those. Anyway, the already sliding VIX got smoked into the bell. That's not a surprise, especially in the summer. But remember, this is in front of the FOMC. So again, if you want to say, well, there's complacency out there, you may be right. It's hard to say. I think there is a little bit. I would agree with that. But who knows if that factors in next week, the week after, which is what we're really looking at here in these videos. Bottom line is the trend is still up until further notice. So this is the thing about these uptrends, that I learned the hard way many decades ago, unfortunately for me. But fortunately, I did learn that, and that's just that they just keep finding a way. And it's you can even be unimpressive, and it looks like there's real problems developing, but then suddenly, right, everything changes, and they're back on their horses, buying everything they can buy with both hands. So that's just the nature of the uptrend at times, and that's why it can be treacherous to fight against these things too soon. Can really keep you from doing well in a trend that just carries for a very long time, and B, can hurt you even worse if you're shorting it. Not only are you not making money on the long side, but you're losing money as it continues to frustrate the living daylights out of you. So again, I had a dose of that many years ago. Remember, I got started over 30 years ago. So fortunately, I learned that the hard way, but I did learn it sooner rather than later, which was good. Otherwise, I'd be toast at this point, I think, with what the Fed and our so-called leaders have been able to do to manufacture to this point. But anyway, as I noted, harder and harder for me to really love the market, objectively speaking, just because I think the charts have become messy and mostly, well, nearly everything that I have to say or how I look at things is really chart based, based on the market action. Because as I've said many times, it's the thing that lies to me the least of everything on Wall Street. So I'm leaving those other items off the table. And on that, let's do a quick positioning or repositioning. I'll dump the notes, get them out of our way, and then we will start to look at some charts, which is always a lot more fun. But I hate to give short shrift to the stuff like that. Let me just get us on screen 4. There we are. Here we are on screen 4. We're looking at SPY. This is our basic technical setup with standard Bollingers set to the 100 SMA here in the middle. That's the dashed line I'm kind of hovering over. You got all your SMAs from the 10 to the 15, 20, 50, 100, 150, 200. They're all different colors, except the short-term white is the 10, and this larger white that's dashed is the 100, which is also the spine, as I call it, of my Bollinger Bands. And then we've got your some basic indicators, oscillators down here, just for judging sort of like relative overboughtness, oversoldness, momentum, things like that. But it's all really basic. It's stuff that a lot of people can follow and or I've at least heard of. So we try to use it. There's other things I do, but those are just time-consuming things that require a lot of explanation. And if you're not dialed into it, it can be kind of boring and you're like, what's this all about? So we stick with the basics and do what we can with these. But anyway, look, you make a new all-time high, but you can all see that candle, even if it's a little bit small. It's not that screaming, okay, we powered up to a new all-time high candle. No, you get this kind of a candle and you back off. So not even your best close of all time after making a new high. So that was a little disappointing. I do think that the screaming that the TNX and the dollar did definitely weighed in on the market. Ultimately, we did also have the QQQ make a new all-time high, and that has a similar candle, which I'll show, which I say I'll show by, well, I overclicked there, but let's try to get this. There you go. Not an impressive candle right there. So what do you do with that, right? Are you extended a little bit? Yeah, you are. If you want to look at your Bollingers and say, well, you're outside of your upper Bollinger, you are. But the reality is that the Bollinger Bands are kind of narrow right now. And that brings me back to something I've been saying where after there were a couple quick bursts, we really did kind of get like volatility where we just really weren't getting great big movement, right? It was kind of just grind a little bit higher, grind a little bit higher. And there's nothing really wrong with that. It's great for, in fact, it's great for covered call or even better, diagonal, long call diagonal players. It's great for that stuff. Well, even for morphing certain other types of spreads and things like that. But it's not great for momentum players that want really strong bursts, right? The more strong bursts we can cram in to a trading day or a few trading days, the better off we are. Sort of like what NVIDIA did earlier on this week. We just had a really strong push there for a little while. But anyway, this is really not what you want to see ideally. At the same time, you have to acknowledge that it is still in an uptrend. It did make a new all-time high. So despite everything, we could say, to sum it up with an asterisk next to it, that's despite everything, it's still made a new all-time high. So it tells me, right, that we know who's in control of this market, but can you feel comfortable about it? Is this really like some of the best, most simple, direct negative divergence you're likely to see in the SPY, right? Where you've got this slightly higher high situation that develops that doesn't close well, by the way, and you've got this kind of ugly sort of indicator oscillator situation down here where none of these are showing anywhere near the momentum type strength that you had going into these highs that were made in here. None of it's the same, none of it's as good. So the momentum has sort of been lost or stalled based on these simple calculations of these indicators down here, and yet you somehow make your way up there. And I think that has to do with the breadth factor, where it's just you're losing breadth, right? So on the breadth side, it's just the new highs, new lows, net, things like that. McClellan oscillator, McClellan summation. Where did it happen to my McClellan summation? Oh, there it is. McClellan summation there in orange. I couldn't see it. It's a little too tiny even for me on my screens, but like McClellan summation is still having trouble in orange. McClellan oscillator in blue, right? That's still struggling. You've got other things like the new 50 stocks above their 50, below above the 50, above the 100, etc., above the 200. They're sort of in decline, right? And so you've got this little bit of a rollover with advancers, decliners too. So is it horrible? No, it's just that our new lows picking up relative to new highs? Yeah, they kind of are. What happens when that starts to happen? Well, you often do get pullbacks, right? So there's a lot to be desired. Having said all that, and this is why I really wouldn't go too deeply into the charts, because with the FOMC looming, you're really talking for the sake of listening to yourself, because we all know that can change everything. That language can change everything. If they surprise the market, there's obviously a few ways they could surprise the market. At the very least, they could say, well, we're just sticking with our long-standing verbal commitment to we're not doing anything until inflation gets back under 2%. Do know that is the bogus inflation data that everyone sort of winks at each other about and agrees to discuss and utilize, which is anyone in the real world that thinks for themselves, that has their five senses and their wits about them, knows that those are complete lies that benefit certain parties to the detriment of other parties. But again, that's been going on forever, and it's just that's the way it is, unfortunately. But it would be nice for someone of notoriety just to say, hey, how about we stop playing with these BS numbers, playing the game this way when they're not even close to reflecting reality. But that's what you've got in here. And we could say, well, what if they do say they're going to stick to that? Well, that's probably a problem for the market. And if they say, well, you know what, with the EU having done what it's done, they won't say this directly, but with the EU having done what it's done and kind of lowering beforehand, there's a precedent there. We need to be in line with the rest of the world, or whatever the case may be. They've shown us the way. We feel like with the data we're seeing, inflation is going to ameliorate soon, and therefore it's okay to do this, and we don't want to do this too close to the election, which appear to look political, as if anybody really thinks the Fed is apolitical anymore. But that's, again, another side issue. But that could really ignite a blow off, right? Where everybody who didn't think that was going to happen in June, or it wouldn't be indicated to happen in June or July, suddenly finds themselves in big trouble. Now, I think that there could be that really initial burst. It could last hours, it could last days or weeks, maybe even longer. But ultimately, we'll just remind everyone that the gentleman, forget his name, but he did at one time, at the very least, work for the Ritholtz Group, and he did produce a study. And my recollection is that you're down over double digits the following 12 months later, after the Fed begins their rate cuts. So it is a case of be careful what you wish for. That's the historical performance. And that's because by the time the Fed starts to cut rates, a lot of negative stuff's already on the way, that's in the pipeline in the economy. And then it really starts to evidence itself in the economy shortly after that. And it kind of gets worse and worse and worse until it improves. So that could be the case, I'm a believer in taking a look at analogs and precedents and tendencies, but really only sticking with them as long as they're sort of tracing out as you would expect them to, right? I'm not going to let that overshadow what I think is happening technically and just say, well, I should probably take some defensive actions here, defensive maneuvers to prevent greater losses, but I'm not going to, because the analog says we should rally. So I'm not going to do that. But we have used this presidential election cycle material now for, wow, I think we started looking at it in the fall of, I want to say it was really the fall or summer of 22 into 23, and then we've used it ever since, and it's been tracking fairly well, so we continue to use it. It's not been perfect, but I wouldn't expect it to be, number one. And number two, sometimes good enough is good enough. And if that keeps you on the right side of the, helps keep you, put it that way, on the right side of the trend, then it's helping you, right? Because that's where you want to be most of the time. So historically, anyway. So there's that. But yeah, I mean, I think we all are sort of nonplussed by this, right? It's not really that, what is this? Like, we make a new high, you get all this wonderful stuff. You have this big burst by the stock du jour. You can't really, in terms of what happened with Nvidia, right? You start out the week and they really, well, if I could get my hands on it, they really pushed it up nicely, starting on the third, right? You come out of the, you come out with this big gap up from Friday into Monday. Just keep going, right? That was a massive burst. We were fortunate enough to have that as the I think UOA Essential name focus, one of the focus names of the week. Out of the 4 names that we put out this week, that was the only one that triggered, but I'll take it. We put 2 bulls and 2 bears out, but that was a great move, so I'm not complaining. Right? Folks should have had an opportunity to capitalize on that one, even though it kind of finished the week poorly. But that's why we roll, and that's why, as I've said many times, you really don't mind losing a little bit on your last roll, because if you've done things right to that point, that means you've gotten 2 or 3 rolls in after your initial position, and you've done very well on those. And that one last one that maybe clips you takes a little bit back, but then you get out. There's nothing wrong with that. But anyway, that's where that went. And you could see that, obviously, it being such an enormous weight in the market at this point, with it maybe, I think maybe being the second largest. I don't know if it's second or third largest company market cap wise at this point, but the SMH looks a lot like it for that reason, and the Qs look like it for that reason as well. Q, Wayne. There, come on, there it goes. That'll come back, I think, now. So yeah, I mean, a lot of these things look the same, as in, it's really the same thing, with XLK, same but different because of the weightings. But so what do we really want to say here? Well, it really depends on what happens, right? It depends on what happens next, always. And we know that basically FOMC is going to be there on, I think, 11th and 12th, with 12th being the day we have our fates decided, and then where you go from there. And if you know what, if you know what they're going to say, what they're going to do, you probably could get a good beat on the reaction, what that's really likely to be, even though you'd never know for sure, because they do play games with that as well. But I can see the potential, right? You have this strong move, you then go into this corrective phase here, you come out of it fairly strongly, fizzle in front of the FOMC. But if you pull back a little bit into Tuesday, and then they start rallying it into Wednesday, and they get what they want, I would expect there to be another leg up, all right, that is similar to the one we've just seen, or something like that. And you take off and go. And I remember even talking about levels like this, and levels like this in the SPY at some point, of like where you really could go. And I think I had a 5,800 level in the, my memory is I had a 5,800 level on SPX, or SPY would be 580. And just on some projections. And somehow through this is what is fascinating, and has always fascinated me. Somehow through all these issues, they still managed to make some of these chart projections work in the end. And you just wonder how it was even possible. When you look back on it, you're like, nothing really great happened, but the market went there, and then sometimes there's not even great reasons in the future as to why it did that, and it corrects, but it happens. Sometimes it is legitimate, and there's good reasons too, but it is what it is. And they often take things a lot further than most people would expect, myself included. You just wonder about it the whole time. Like, this is astounding, given how, let's say, foobarred so many other things are. But again, I think it really comes back to just money flowing into the market. Now, when I stop and think about what really matters is money flow, right? If people are committing more capital in the bigger names, which they tend to do, then they're pulling out, then you tend to go higher. And that's just it. And then the weightings are obviously a big factor. And so a lot of people are perplexed by the fact that we keep going up. But if you've got a massive weight like this that's doing some of the things the stock's doing or has been doing, that's really the the main factor, right? That's the thing that's driving it. I mean, literally, right? That because of the mathematical calculations, the price, the weightings, etc. That's what's driving it, and so that does make kind of gloss over problems of a lot of other companies. A lot of other companies are really struggling, and a lot of this is really made possible by this. But you can't say, well, this index shouldn't be here, has no business being here because a lot of these stocks are doing poorly. That's true, probably, but look at the weightings and look at what this stock has done and realize you're talking about an index that's based on those types of things. So it's the math. It's not really right. It's not anything else. It's just the math. So it does, if you think about, it's the logical fallacy. You can't ascribe that the SPX or SPY is the market and it reflects the economy, and that's what it's not that clean and clear cut. We know that, so we use it as a proxy for it, and we think of it, a lot of us think of it that way, but at certain times it doesn't really reflect a lot of realities, and other times it does. So yeah, it's not a consistent, right? It's consistent correlation, or whatever you want to call it. But anyway, we know what that's done. Does have a little bit of a wide of a Bollinger, but it's been wider. I think the stock has more juice in it. I think the stock can go up to about 1337 if they get their hands on it again. That's kind of like when I started thinking about that number, it really was a lot further away, and it looked like kind of like an impressive target in the sense that, wow, that stock could really move to there. But they got it up to 1255 this week, right? So they were a lot of the way there when I first started thinking, where could this thing go to? So that just is not that impressive anymore to go up another whatever $130 from here. But at the time, it seemed like, wow, that would be a really strong move. But that's an impressive move that is realistic, right? I'm not saying that higher ones aren't. I'm just saying it's still a lofty target, and I think it can get there. But again, it itself, the splits happening on 610, right? So we're talking about on Monday. I don't know if that'll usually the fun and games are over by then, but I could see anything happening. I've seen both where they still love it, like now that it's cheap and they go after it. In their minds, it's cheap because it's been cut down by a factor. So you're looking at $121 stock, and people can't wait to get their hands on it. So that could drive it. We'll see. That's the good thing about the market. We always get to see. But the other things that we should cover here in macro measure are that the diamonds, right? We kind of said they were having a rough go of it. They did start to recover late last week. They followed through on that. Another one with an unimpressive Friday, right? Where it starts to go, they get near the 20 there in light blue, excuse me, and then they're just smashed back down. So you almost have what could have been an outside day. I don't know, low 387.79. Yeah, almost an outside day, but saved by the 50 today, saved by the 100, right there in short order. So SMA support saved it, but it did hit SMA resistance and really got sent packing. So that's not the kind of action you want to see. Again, I'd always be cautious about drawing too much from one candle, right? One candle doesn't make a situation. And if we do this, I think that's it, right there. I mean, for me, that's it anyway. So if you lose the 100, you're also losing that sort of short-term dynamic that's been in place since it bottomed. And that would, to me, would bring it, that would start bringing about more selling. And then you've got to get above the 20 there. So I'll just throw some levels out there. You got to get above the 20. That's near 392. If you can't hold the 100, which is at 387.42 right now, you're probably in trouble. I'll do the IWM. I'll do some other things, and then we'll get close to wrapping things up. But you got to say, right, if you're thinking as the IWM as a canary, doesn't look good, right? That's threatening to break down below the 100. There's a little bit of an SMA air pocket there. The 150 doesn't come in for about nearly I think 2% away. So there could be a little 2% air pocket there if it does start to really fall apart. But you've got the lower high, you've got the lower low happening here. It's a little messy, but it's got that, and not a great sign, right? Still could be right in a corrective mode of this impulsive type move here, but you really want to see this thing support close to where it is now and not really dip even more. Remember, better trades are typically found after more shallow retracements, to put it just in a simple way, I think. And that's my take on it anyway. Usually because that just means they didn't let it fall, that even when the Bears had their chance to really shine, they didn't shine all that brightly. The Bulls really were not ready to let that thing fall. In other words, they're ready to step back up and start buying at a higher sort of base camp. Anyway, on this, so you could see where this has got its trouble. You could see where also it almost sort of has like kind of like an inverted head and shoulders potential if it can start to round back up again, which maybe could fire, who knows. But anyway, there's a lot happening there. I don't think that looks good, though. I mean, if you ask me, what are your thoughts? I think the IWM is in trouble. I've got a bearish idea in on that. It may have triggered. I can't recall where the trigger was, but we've been waiting on that. I think it triggered last week or early this week and kind of hurt some folks because they didn't stay there for long in their disciplined pro level traders. So they, I'm sure, got out of it smartly, as they always do. But anyway, that still doesn't look good to me. The diamonds acting the way they did does not look good to me. I'm not saying they're as bad as IWM. I don't think they are, but I think you definitely have to wait to get above the 20-day there in the diamonds before you feel better about that. In other words, I think it's sort of on like concerning watch right now. This is definitely on concerning watch. I hate to be redundant, but I'm really not touching this until it gets above the 20-day right now. And I know that's a long ways away. Now, you could front run that if you start seeing some price action or other encouraging signs and just get in aggressively with an aggressive nearby stop that's rock solid. But overall, right, the kind of short to intermediate term is down right now, and it made a new low and closed at a new low right below, I think, the 100-day by a little bit. So that could be the old drop below the very obvious, widely followed moving average, and then really stick it to people move, which these guys excel at. But then again, it might be legit. So that just not a good look, though, right? If you just say this is at this snapshot in time, how does this look? Looks concerning. Diamonds look somewhat concerning, not as bad as IWM, but they're there. The Qs and SPYs we already talked about. We'll go back just to be thorough, but that's great. But they do have negative divergence. They did have a poor close. You've got the Fed coming up. You don't know what the Fed's going to do. It's really tough. I think if they post Fed, if they change language, I would definitely be willing to buy for that short kind of initial burst for hours or a day or two following the Fed announcement and the right language. I do think they could definitely melt up here and really have that sort of crescendo type move that you often see where things just end, and that's the end of that sort of bullish cycle, and it got out of control and everybody was impaled by bulls, and everyone's capitulated, no one's left to buy, and then they let it sort of come back down. But again, I'm not impressed right now. Even before the Fed, though, I would buy if it broke out. The trend is up. They hesitated for a couple of days here. They took the short-term overboughtness out of it. The Fed's been, overall, they've been shrugging off the Fed. Obviously, the Fed had to stay higher for longer, and you're making new all-time highs in the face of that, right? So unless it's really bad news, like sorry to disappoint you, but you're not getting a damn thing in 2024. which I doubt they'll say in so many words, of course, but never know. If they do, that's a different story. Spider. So I'm a new high buyer there, especially if you've got XLC and SMH working. Spiders, the same thing. I would still be a buyer. The trend is up, but I'm not going to sugarcoat it and not say I'm not concerned about breadth. I'm not concerned about these negative divergences. This is really an unimpressive finish to the week. All those things in my book are true. It is unimpressive, but it's not right. It's not over yet. Just because you have a couple of unimpressive sessions after after a couple of days of burst and you hold most of your gains, that's not the worst thing that could ever happen to you on the charts as well. So I hope some of this is making sense because I'm jumping back and forth, but that's as things come to mind that I think can maybe help from things I learned in the past, I just try to jump back and share them. Here's the recovery on Friday and virtually Friday alone by the dollar. And you can see my line and where it was. And we talked about these being near crucial support, and they were plummeted through, but right, they kind of outside dated in a big way. That's a really strong candle, and that's concerning, right? Because the dollar moving back up, not a good sign. I do think this ultimately did weigh on stocks today. One reason why they didn't power as strongly as they could have otherwise. And this does look like it could start to create trouble again. So maybe, right, maybe there's some thinking that the Fed isn't going to deliver what the rose-colored lens crowd craves the most, which is just more support for equities. That's where they always are. So you're getting there, right? That could pop. I guess if you get above the 50 in gold there, that's definitely a concerning sign. You're back above all your SMAs. And this may then start looking like a real shakeout maneuver where they shook people out and then they reversed it hard and now they're ready to go again. That really wouldn't be good. I don't care. I know that they've rallied in the face of that. I think that would be a little bit of a shock to the system right now. That's just my own take on it, kind of more of a gut instinct takes. But I'm just saying that, yeah, if they start powering this thing through and you start to see another monster day up and you start approaching 106 suddenly from, nearly dropping into the 103s and then you're suddenly right back at 106, I don't think that bodes well for equities at the point we're at right now. Just saying, as they say these days, just saying. So I'm going to go TNX, CGI. This was obviously also one of the culprits today. You'll see if I can enlarge it a little bit. I mean, just to give this candle its due, it's a pretty strong reversal candle right there. And again, something that was on its way down, you were dropping into the 4.2s, and then lo and behold, right, they start working this back up and you're almost back into, right, you're back into 4.43, or in this case, 44.30 on the TNX. So again, not much it would take not much to just get this right back above all SMAs again. This would really kind of look like that final shakeout, and then you could easily burst and break out beyond the resistance line we'd get if we connect these two highs. And I think to me, that's a little concerning because I'm somebody that thinks rates are important. So that is not a good look. You start taking that out, not a good look. So especially right after this nice sort of shakeout maneuver, that would be, and that's the thing. They do have this tendency, right, to quickly move things back up after they puncture a line briefly. So here they did it, right, as these are the only two times they did it, but right back up quickly, and they continued, right back up quickly. So just be on guard for that. Is that's why we do these videos, right, to try to prepare ourselves for different things, to not really be caught off guard and run some scenarios through our minds and know that, okay, this is what they're doing, and let's see how the markets are reacting to it. If they shrug things off, they shrug things off. But if violent moves are made by TNX and the dollar higher, I don't think it's going to be shrug off time. I just don't. Okay. On the flip side, I do think that if the Fed sings the song that they want to hear, then I do think there could be a really final crescendo type spike. We'll see. This, right, VIX, an ugly week for the VIX, finished poorly, right? You're not very far above where you'd have an 11 handle again. 11 handles are pretty rare these days. We only had one briefly. Remember, you have to go back many years to find a VIX that's as depressed or suppressed as the VIX here, right? If we go back to where that 1152 number gets reached, you're going back quite a ways. You've got to go back, I think, at least 6 years. I think we found out right before. So it's somewhere near here when you were back at those levels, and that's back in 19. So yeah, 5 years to get to really this kind of a depressed, suppressed, take your choice type of a level. So once again, we've said this many times, but this is every time we say it, there seems to be a little bit of a pop not too long afterwards. But once again, if they get this stuff down there post Fed, if they scream the market, Fed says what they want, they scream the market, this thing could get really bludgeoned. And if it does, you might see a lower than an 11 handle. In that case, I would definitely tap Ryan or Greg on the shoulder during the webinars this week or next week and say, look, guys, I want to prepare for possible vol pop in the future. Where would you guys go? As I've said in these videos, I would tend to go towards OC Nov. I don't like owning DEC. The only time I like to own DEC is when the DEC expiration is earlier, way in front of Christmas. So I wouldn't want it to be, the DEC expirations like the 21st or the 20th. I would rather have it on 15th, 16th, 17th, because once you get through that expiration, quite often that final few weeks of the year is bull markup mania time, and that obviously suppresses volatilities. And not only that, but there's listless trading and there's a lack of interest often. If there's been a good year, it's kind of like, let's just celebrate, not let stocks fall. And then really people are getting crushed. So volatility really sucks in, and you get really you can really get hurt if you own late DEC or early Jan. That's why I avoid those. So I just skip right over Jan and go straight to Feb. Because then you'll be dealing with volatility from the fourth quarter EPS, which is always good to own cheap. And then I like to own May as well. But those were my months really: Feb, May, and then Octave. And of course, sometimes you get sprinkled in this or that. But I don't like January because those are former leaps, and you can get saddled with that along with everybody else, and then everybody wants to get out of it because it's not doing anything. So I tried to, throughout over the course of the year, kind of get out of that stuff, get myself into February if I could. And from I would do a lot of Jan, Feb spreads, things like that to get out of that and get out of DEC as well. But anyway, I would talk to Ryan, talk to Greg about that. That's my 2 cents on that. And I'm just going to say on that note, I think, as I said, I could sit here and make predictions, but in the end, the bottom line remains that the market trend is up. It's the breadth is not all that great. The sector action is not all that great. My spider sense is tingling a little bit still, not ratcheting up, but just sort of like it's on like a very light simmer. And I'm sort of like, yeah, there's something really wrong here. The market just doesn't look as good as it did. That could change, though. That could really change, where there could be a surge if the Fed does what they want. If they get the Fed, I don't think that the Ritholtz material is wrong. I just think in the initial aftermath of the Fed cutting, there could be this euphoric reaction, and it could then lead to a hangover. So we'll have to wait and see if that happens. But if the Fed disappoints, the charts and the breadth, et cetera, are saying that shouldn't be a shocker. So that's where you're at. So again, like I said, you could skip the video pretty much and just wait to see what the Fed does and then react. But we try to talk through things in each week to see if hopefully that'll help in some way. And as always, I do hope that it helps you in some way this week or some week in the future. I do want to thank everyone for tuning in. And again, I hope you got something out of the time we spent here. And what else can I say other than have a great weekend, have a safe weekend, and get ready for next week. Hopefully, we won't have one of those really boring lead up to the Fed type weeks and then really not much happening afterwards. I'm kind of sick of those. I really would like to see the action really pick up one way or the other again. So hopefully, we'll get some for everybody that's not short vol. We'll get some really good movement to work with next week at some point. So everyone take care and thanks again.